So I want to do this video about understanding how important cash flow is when building a property portfolio. 99.6% of Australian investors don't have more than 3 investment properties. 75% of Australian investors don't have more than 1 investment property, and that's 75% of them. And that's because they don't understand the importance of cash flow. We go out there and we look at a property in our own backyards and we purchase something, and 9 times out of 10 it's going to be a negative geared property. They haven't done their research, they don't understand the market, they don't understand the rental market, they don't understand what's happening in this particular market, and they don't understand finance. And they purchase an investment property, and it's all good if it's growing 10 or 20, 30, 40% a year, but if you're over leveraged and you purchase something negative geared, the banks look at that as a liability. And why they look at it as a liability? Because the rental income from that investment property is not paying for all its outgoings. It's not paying for its mortgage, its principal repayments, it's not paying for its expenses, water, electricity, or rates, or body corp if you purchase something like that, or insurances, etc. And you have to keep pulling out money from your own pocket to pay down the property. Now, if you purchase something like that and it's costing you $5,000 or $10,000 or even more than $10,000 per year, that's a liability. The banks don't look at it as an asset. So you've got to understand how to make sure that a property is going to put money from your pocket, and how you can get that property to keep producing income that's going to increase your income as well. Now, I want to talk about, understanding the size of lending, because this is super important. Now, talking generally and depending on the property and how much it's producing of positive cash flow, but I'm just going to talk broad. Now, if the property is cash flow positive, and you purchased it at $500,000, and you haven't maxed out your budget, but you've purchased it, a property that's $500,000, it's cash flow positive. Now, the banks will give you 80% of that purchasing power back as your borrowing capacity. So you purchased at $500,000, it's cash flow positive, they'll give you $400,000, which is 80% of the value of that property, back on your purchasing power as your borrowing capacity, so you can go out there and purchase more property. Now, it's very general, it's broad, it's depending on your situation. But if you've got the right team, you understand understand the finances and where your situation is at, you can actually structure your portfolio and make sure that you're getting investment properties that are going to help you build wealth over time and help you keep borrowing from the banks. Now, people look at negative gearing as, it's a great way to write off tax. Now, I want to ask you one question. Are you investing in property for wealth generation, or are you investing in property for tax advantages? That's a good question. And for me personally, I'm investing in property for wealth creation. I want to build wealth. Now, you can have tax advantages by using properties that are still cash flow positive, by making sure they've got depreciation. Writing off depreciation so you can lower your taxable income. All your expenses you can claim back. If you do renovations or upgrades or developments, you can claim back on deductions. But I'm purely in it because I want to, produce wealth. I'm not in it for tax advantages. And people that do that, they're doing it as a hobby. They're getting some bad advice and they're not succeeding. And that's why they have more than 3 investment properties, some of these people. So you've got to understand, you're in it here for wealth. I would rather pay more tax because I know my property is producing more income. It's not a bad thing. You got to change the analogy. If you've got the right team around you, accountants and brokers and a buyer's agent, you can write off tax and still be in a positive surplus and still, use that money to do whatever you want with it, and help your family. You want to, help the community. You want to, buy things for your family, etc. This is understanding, finances. But I'm not going to talk on that too much. I'm going to talk about cash flow positive. So let's just say you've purchased a house. And I'm talking for someone to how to increase their income. If you're someone who has a PAYG, even if you're self-employed and you're struggling to get revenue every single year, how can I increase my personal income? How can I increase my revenue by using assets that are going to put money in my pocket? How can I do that? So let's say you've purchased this property, and this property is producing $5,000 after all expenses are being paid. All your outgoings are being paid from the rental income. It's producing $5,000 net. Not gross, net. So that cash flow every single year is putting in your pocket. Now, let's just say you're someone that's your gross income is $60,000 per year. Now, what happens is the banks look at that and they go, okay, if you're someone that is increasing your income, how are you doing it? By you've got an investment property, and that $5,000 that you're making after all the expenses have been paid, that contributes to your income here. So then that goes up to $65,000 gross / net. Depending on what your net is on your income, it's going to be a positive. Now, if you understand the finances and you're not maxing out your borrowing capacity, and let's just say you've purchased this house at $300,000. Now, your borrowing capacity, let's just say this person's borrowing capacity is $600,000. Now, they haven't maxed out and bought a $600,000 property. They've gone out there, they've bought something around $300,000. Now, this is just very broad. Now, they haven't maxed out, so then they get the majority of that purchasing power comes back onto their borrowing capacity. So they can go out there and purchase another property, and depending on where they're at, if they purchase the right next investment property, which is their second one, then that's going to increase their income, it's going to increase their borrowing capacity, and then by the time they have enough savings, or if not equity from these properties, they can release it and go and purchase another property once again. So it's understanding cash flow. Understanding that you don't want to get stuck, purchasing properties that are negative geared properties that are going to hold you back. Because if you purchase something at $600,000, and let's just say this property, it's costing you, you purchased this property at $600,000. I'll write this off. You purchased this at $600,000 at your max. Okay, it's costing you, let's say $5,000 per year. Might cost you more, might cost you less. Let's say $5,000 a year. You've maxed out. By the time you can pay, you have to pay down a certain portion, depending on your situation and your income. You're going to have to pay that debt down enough, so then the banks can say, you know what, we can lend you now because you're not a high risk client, and they'll lend you more money. But how long will that be? How long will that be? If that property is costing you $5,000 minus every single year, and you haven't factored in there's expenses that pop up, like your renovations, or something comes up, hot water service blows, this and that, or maybe your lifestyle, you've got things, you've got your kids, you've got family, or you want to get married, they're extra expenses, they're going to pop up as well, and so that then your cash flow is dropping significantly, and then you're trying to pay down a property where you have to keep contributing every single month, every single year, and it's going to hold you back. So you've got to understand that you've got to look at, not just looking at growth, you've got to look at cash flow and growth at the same time, which you can do. So I hope this gives you a bit of clarity and understanding, because if you did something like this, by the time you can pay down that, because you're not going to put a significant amount of principal repayments to a property. So by the time you pay that down, you might have to pay that down $100,000 or more. So then you can actually borrow again. And by the time you do that, that can be 10 years or more, depending on where you're at with your journey. So hopefully you got an understanding of how important cash flow is at the beginning, and how understanding the game of finances, because that's what it's all about with property.